it is not just the method, it is not just the trading discipline or your psychology, guys. Of course, it's a combination of all of those, but what is even more paramount than all of that is something called a trading edge. So what is a trading edge? Imagine you're playing poker. Undeniably, the strongest hand of cards is the royal flush. So imagine you're holding a royal flush and then that anyone else around you, there is no chance that someone else can have stronger cards than your cards. In this situation, you're certainly having an edge. A trading edge is the exact same thing. You position yourself in such a situation that no matter what happens out of this situation, you would still end up being the winner. In trading, it's not different. A trading edge could be anything from an inside information through latency arbitrage, which also is kind of illegal. This could also be any other type of advantage, which let's say an algo can give you, or a high frequency trading mechanism can also give you some sort of a speed advantage versus other market participants. In our case, our trading advantage, which I do teach in the day trading program, is called pricing discrepancies, or these are those short windows of opportunity that the market is giving you an unfair advantage versus the other market participants. And the purpose of this video is to show you exactly this trading edge. So I'm gonna walk you through 3 trades, 2 of them taken by my students in the day trading program, and another trade was recorded by accident by me when I was actually teaching another student how to use the trading room, and we managed to record an almost 20x trade in real time thanks to me trying to help this student out. So in this video, I'm gonna walk you through those 3 trades. The one and only uniting factor between all of those trades is our approach and our framework, which uses pricing discrepancies. Let's have a look, guys. This is the Dow trade that was literally taken after the Nasdaq trade, and I'm not sure in the trading room if you're already seeing that. So here I'm saying short Dow. This is where we shorted. Then this trade turned into a risk-free trade very quickly, and currently it is still going lower. So this is where we shorted, and I'm letting this trade run. I hope this makes more sense, and I hope you're not feeling lost, and you can actually see those trades in the trading room now. It is under the VIP area. It says trading room. Quite lucky today for me. Almost 1 to 20 on this trade. It's 1 to 19, and I'm gonna close the trade here. So that was a very, very good timing for you. So I'm happy that you can actually see how this whole thing has progressed. And let's move to the next trade, which was a trade taken by one of my students, and he literally just shared this this morning in the day trading room in the community support section, and this is the 26th of November. So this trader has literally had a 27 to 1 or 1 to 27 risk to reward ratio trade, and he only risked, I'm not sure if you can see, 10 euros, and he made almost 270 euros on this trade. The other trade was taken by another student of mine, and he shared this in the trading room. So this is where he entered, and just a few minutes later, you can see the price is going lower, and then the trader is saying that he closed it for 1 to 14 risk to reward ratio, and this was the exact same trade that I took in the trading room. As you can see, we literally entered, even though he hasn't been copying my trades. The point is to learn how to use the system. So he's using the system precisely as he should. And that's where he entered 46,780. I entered 758. So his entry was even more precise than mine. This is the DAX, by the way. So we closed at slightly different levels. So he booked 14 X's. I booked 16, 17 X's. So more or less in line of what I booked as well. But this shows you that there is one thing that unites all of those trades. And this is first finding those pricing discrepancies. And then after that, being able to de-risk the trade, which we've done. And the third and last thing is to max out the best trades and get very high returns. In this way, once you're de-risking the trade, you're not risking anything at some point of the trade. And then the last and I would say most important thing is to be able to max out those trades, because if you are not maxing out on the winning trades, then you are not holding a strong enough edge to consistently make money in the long term. Last but not least, I wanted to share with you also the two best trades of this month. So honestly, it's about the consistency. It's not about hitting one double-digit returning trade and then not being able to get into any other trades. This is not how it works. You need to have consistency, and this month has been quite decent. I would say the best trade was a 60x trade, or 1 to 60 risk to reward ratio. You can see in this screenshot I've actually moved the stop loss lower to lock some profits, but this is how many X's it finally gave us based on the initial entry of this trade. And then the other trade which gave me 41 X's, this was a trade on Nasdaq, and I held this trade for around 5 days, and at some point it was almost 100x trade, but unfortunately I couldn't see this happening at the time being, and I kind of missed it, and then I closed this trade at only 4-ish x's, or 1 to 41 risk to reward ratio. As in life, so in trading you need to have some sort of an advantage if you want to win against other market participants, because let's not forget that trading is a zero-sum game. So if you don't have a very clearly defined trading advantage, that for sure that you have a trading advantage. You're not just guessing market direction or hoping that flipping a coin X amount of times will give you more winners than losers. This won't be a good enough advantage to hold you over the long term. So if you don't have this type of advantage, you need to be very careful when you're trading, because you're trading against other market participants, and a small percentage of those market participants will probably have some sort of a trading advantage, so they would make the majority of the profits, whereas the majority of the traders, they would actually lose over the long term. So you need to be very careful, and having said that, never risk more than you can afford to lose, as the saying goes, and always try to max out your winners as much as you can. This was from me today, guys. I'll see you next time. Bye.